Are you looking to sharpen your budgeting skills? You're in the right place. Welcome to the Budget Couple Podcast, where we talk about life, family, and how to afford it. And now, the Budget Couple themselves, Nate and Danielle.
Welcome to the Budget Couple Podcast. I'm Nate.
And I'm Danielle.
And this week we're going to be responding to another viewer, or I should say listener question. Sorry, this one got lost in the mailbag a little bit. This is actually an email back from the middle of July. We apologize deeply for taking so long to get back to you, but we did want to make sure this was the next thing we had scheduled. So here we are with it.
Yeah, we're very sorry. It was a crazy summer, as we mentioned, and we took an impromptu break, but we did want to get around to this one.
Before we move on, thank you very highly for the recommendations and reviews that you've left us. It really helps grow the show, and we've seen an increase in listenership just because of those reviews, we think. So we really appreciate it, and if you haven't already, we please implore you to go through and leave us a review. It helps the show grow and helps us answer more questions. So let's go on here. This was a pretty long email, so I'm going to summarize some bits and pieces of it, and then Danielle will get to the meat of the question of what was asked. So we got an email from a listener, and she's married with one child and another one on the way. Her husband and her have a combined income of around $79,000 a year right now, and that's pre-taxes. So they're looking at a monthly income of about $4,000 after taxes, and these are all just rough numbers here. In about a year, her husband's going to get a massive increase in payments, and he's going to be making, or I should say they're going to be making a combined $144,000 before taxes, or roughly about $8,000 a month after taxes. Right now, they have two debts to their name. They have a 0% interest rate on a car with about $9,000 left, and they also have about $30,000 in student loans. One of the awesome things that they have is they have $47,000 in savings, which is phenomenal.
Very cool.
Yeah, it's just very cool. Very, very awesome to have that much money. They're currently living with one of their parents, but when they do want to move out, the parent's actually going to move in with them. So they need to get a decently sized house because they're going to have two married adults, an adult, and two kids running around. So they've done some research, and in their area, they're looking at about a $330,000 house, which is totally in line with their income. So if you're making $144,000, a $330,000 house is totally in line. You could probably afford a lot more, but you don't need to. If that's what you want, that's perfect. I'm really happy with that.
So also just wanted to make sure we pointed out that they are living with a parent right now, so they have no living costs. They are not actually paying anything to be living there. So that's really awesome. It gives them a great opportunity to save. Now, the question that we want to get to, I'm going to go ahead and quote this one. Do you guys think that it's more important to pay off debt or save as much as possible? Or if the answer is both, how do you do both at the same time? What should the balance be? I feel like having less bills when we have a home will allow us to make bigger mortgage payments, but having a big down payment is beneficial too.
So that's a loaded question with a lot of detail based on the facts you gave us. And thank you for providing all that detail because it really helps inform our decision of what we're going to do here. So our first step when we think about something like this is to just pull up a calculator and run through some numbers because that's kind of the nerdy people that we are. We like running the numbers and seeing exactly how everything works.
And when we say calculator, we actually mean both. We need like an old school calculator, and we also use calculators online at various sites where you can plug your numbers in. It'll give you information about what type of mortgage you can get, what your interest rate might be, and that sort of thing. And
I'll include links to some of the calculators that we use just so you can see them in the show notes. But let's go ahead and run some numbers here. We're going to keep a couple things consistent. Really, only one thing consistent, the income. The income is going to be $144,000. We're going to change the down payment, how much the monthly debt is, how much for home they can actually afford, and what the estimated payments after mortgage and debt combined are going to be each month. So we want to figure out how much money they have to pay out each month before all the other stuff, like utilities, cable, childcare, all that. Just the basic things that you have to pay.
Okay, so the first set of numbers here, we're assuming, again, an income of $144,000. Let's assume now a down payment of $35,000. So one of the things that they told us in the email was that they have $47,000 in savings, but they want to, if they were to go ahead and save, their goal would be to have a $50,000 down payment and $15,000 left in savings after that. So they want to get up to $65,000 from that $47,000 that they're at now. So what we're doing with that $65,000 that we have, we're tossing $15,000 of it away for your savings, for your crash fund. Some of that is going to be used on closing costs, we're assuming. And even if you get some of those closing costs paid for you, there are still other associated costs with buying a house that you run into without realizing it. So we're assuming around 15 to 20 in closing costs and or other things. So that leaves $35,000 as a down payment. So this is assuming we're going ahead and saving this next year. Just
saving
all out
every
saving.
penny. We're going to just put every penny we have into saving and save up as much money as we can have. So we have a big down payment and hopefully a smaller mortgage because of it.
So down payment of 35. Monthly debt, we're assuming at around 800. So we're estimating 200 for the car and 600 for the student loan. We're not sure on this one, but we're just doing a quick estimation. We're assuming that we're also assuming that the interest rate for the student loan is probably going to be a bit higher than what a home
roughly
interest
about
rate would be.
6% is, I think, pretty average, 6-7%, somewhere around there.
So in that case, plugging in all those numbers in a couple different sites, it looks like you can afford around $468,000 for a home. Probably a lot higher than what you would want, and I would agree that that's on the higher end for me as well. So what we did after that was then take it down to that $330,000 level. So you're left with that. You can afford $468,000. Probably not what you want to do. What you want to do is drop it down to that 330. You guys have done your research, I'm sure. You know how much house you need and how much you feel comfortable affording and what you can get in your area. So let's go ahead and get rid of that 468 for now, and let's just say 330,000. So we ran the numbers for that, and your estimated payment, given all of this information, would be around $1,600 a month. Pretty affordable for a $330,000 house. But then on top of that, each month, you're still going to have that $800 in debt. So you still have that $200 car payment and the $600 student loan costs as well. So your total monthly payments for the mortgage and your debt equal out to $2,400 a month.
Okay, so now we're going to take one of the debts, we're going to totally eliminate it and see how it changes the numbers. In this case, we're going to pay off the car, which right away I'm going to honestly say I wouldn't recommend doing because it's on a 0%. So we ran the numbers just for fun to see what it would look like. So let's go through that. The income remains the same. This time the down payment is going to be $25,000 because we have about $9,000 left on the car. So we're going to minus that out of the down payment. Our monthly debt now shifts to $600 a month instead of $800 because we're not paying on the car anymore. So we save $200 a month. The house we can afford still well in excess of what we're looking at. It's a $457,000 house, but we're looking at a mortgage at $330,000. That comes out to be about $1,800, and then we have $600 of debt. So we have a total monthly out of pocket on our debts, which is our house and our student loan, of $2,400 a month. So paying off the car does nothing to help you. You're in the exact same situation other than you don't have to worry about making an extra payment every month.
It's really interesting to see just those numbers there, comparing paying off nearly $10,000 of debt versus not paying it off at all and just saving. Pretty much exactly the same monthly payments that you're evening out to. Now, the third thing we did was to look at what would happen if you took that $47,000 that you had right now and used $30,000 of it to just wipe out that student loan debt immediately. So going back to everything, what would actually change? Your down payment, of course, would change. So you're not going to be able to have as much saved for your down payment. In fact, it would probably be about in half. So we're looking at $17,000 saved. So what I would do is pay off that student loan debt. You're left with $17,000, and then spend the next year putting in stuff for your house, just tossing everything in for your house. And that leaves you probably about $35,000 in all. And half of that would be your down payment. So $17,000 down payment. Your monthly debt estimate now is just $200. That's just your car. And you can afford about a $452,000 home. Now, again, way higher than what you would want. Interesting, though, that it's not really changing the number on how much you can afford. But that's okay, because you guys are way lower. You're at $330,000. So running the numbers on that, your estimated payment is actually at $1,800. So it's interesting. Your down payment dropping to that $17,000 didn't really impact your monthly mortgage all that much. And honestly, we bought our house for $350,000, and we had only $17,000 down payment. So, and what would we have? Our monthly mortgage payment, I think, was
$2,100.
21, yeah.
Because our taxes are also rolled into our mortgage payment.
Yeah. So we have a couple other things. So we're at $1,800 for your monthly mortgage payment, plus that $200 that you're still paying on your car in this case. You're at $2,000. So compared to the other two options of just saving all out for the house or paying off your car and saving some, you're comparing $2,400 a month with $2,000. So just running the simple numbers on this, it seems to be better to pay off your student loan. It actually will lead you to lower monthly payments when you combine monthly mortgage and monthly debt.
Yeah, if you go through this, it saves you about $5,000 a year, which is not a small chunk of change in any step. Like, I would love to save $5,000 a year. So I think our recommendation, if you're taking a look at this, is get rid of that student loan debt. It's a huge number, and you can afford to get rid of it. And you still have $17,000 left in your savings account. And then the remainder of the year before you decide to go house shopping, you can really work to build up your emergency fund. So that $17,000 you have now can be used as an emergency fund for right now, but that's going to be put towards the house. And in the next year, you're going to really work to get that savings ballooning up as big as possible. And that will become your new savings fund.
Here's the thing. I mean, putting a huge down payment on your house would be awesome. It doesn't do a lot for you, though, in terms of interest rates and such. Interest rates tend to be more, they tend to use things like credit score and such more than how much of a down payment you put down.
At least in our experience.
Yeah. Though you could lower your interest rate a little bit by having a big down payment. But it seems to us that over the next year, it's not going to move the needle so much on your down payment that it would be worth it. So another thing to consider is PMI, private mortgage insurance. And generally in most areas or everywhere?
I'm not sure, actually. I think it's everywhere, but it could be in different areas. But that's if you have less than 20%, you have to pay an extra fee to insure the mortgage because there's a higher likelihood that you'll default.
So, I mean, in all likelihood and actuality, you're most likely not going to get to that 20% down payment mark. You know, at $330,000, you're up over $60,000 for a down payment, and you just won't be able to get to that point over the next year, which is fine. We ended up paying PMI, and we were able to throw everything at the house for the first couple years and refinance and get rid of it really quickly. So we didn't worry too much about the low down payment on our case. I mean, we already have $100,000, I think, down on our house now. That we've paid off on our house?
Not quite, but with the increase in value, yes.
Yeah.
So, I mean, that's another thing to consider is if you do choose to refinance down the road, if your house goes up in value, that's less that you're going to have to owe kind of as far as going to the bank because they judge the refinance based on the value of the house.
Yep. So, I mean, honestly, there is no right or wrong answer in this case. It's not going to be a huge, huge difference. We just feel like with the student loans most likely having a higher interest rate and the fact that you have that money there to just pay them off and get rid of them, we would probably go ahead and do it and opt for a slightly lower down payment just because that's something you can work on over time.
Yeah. And again, it sounds like you guys really have your stuff together. So you're really setting the world on fire with all this. Like you're doing a great job and tremendous work in what you've done so far. But with your expected income, where you're going to be making about $8,000 a month in income here in about a year from now, you're going to be fine if you have that 400 or don't have it. So if it makes you really uncomfortable to throw it all down on something, that's fine. If it makes you comfortable, hold on to it, do that. But if you're going to put money on something, put it on the student loan. Even if you don't pay all the student loan off, the more you can put down on it, the faster you get it paid off. And that means you have more money available to you. Because the single biggest thing on your income right now, or single biggest drain that you have, is your student loan debt. The faster that goes away, the better off you'll be because you're going to have to pay that student loan debt off well before you ever pay your house off.
Definitely. So again, we just are really excited to hear this. It was a cool story. And the fact that you guys have done such an amazing job saving, that's freaking awesome. I think you're probably doing better than we are on that regard.
Yeah, it's a phenomenal job. I really can't commend you enough for the work you've done and just keep doing that because when you get a big bump in income, it's hard not to go out and want to spend money because you know what it's like to have money all of a sudden. Please resist that urge. Just hold off and try to knock out debts or put stuff down on your house just for a little while until you adjust everything. Because when you get a big bump in income like you're expecting, it's better to live like you don't have that money until you can adjust to having that money.
Definitely. So we're going to go ahead and wrap it up for tonight, but we thank you guys for the awesome story and question. and we look forward to many more. We have one more down the pipe here that we're going to be talking about next time.
Absolutely. So if you have any questions, again, please use the contact form on budgetcouple.com, and we will make sure we don't lose it this time, but we'll make sure we go through and have it ready for you. Thank you so much. And remember, you can always visit our website for show notes and for other information on how to contact us or blog articles about budgeting. Thanks so much, and we'll see you next time.
Thanks. Bye.
Thank you so much for listening to this episode of the Budget Couple Podcast with your hosts, Nate and Danielle. For more great content and to stay up to date, visit budgetcouple.com. Make sure to check out the next episode of the Budget Couple Podcast, where we'll talk more about life, family, and how to afford it. We'll catch you next time.